Hello, my name is Brzeski from Arixa Capital Advisors. Today I'm going to cover three topics. First, what is non-bank real estate lending as an investment strategy? Second, why should IRAs and other wealth managers consider it? And third, how should they conduct due diligence on investment managers in this area if they're interested? So after the financial crisis, banks pulled back from real estate lending to investors and developers. And that created a vacuum, and non-bank real estate lenders have filled that vacuum. Basically, the strategy is making short-term real estate loans, typically 12 months to 24 months, to investors and developers so that they can get capital quickly and with certainty of execution, which banks are not able to provide. And non-bank real estate lenders create portfolios of these loans to generate interest income and preserve capital for their investors. And that, in a word, is the definition of this strategy. There are a number of advantages to this strategy. First of all, it tends to create high yield because borrowers will pay a fairly high interest rate to get the certainty of execution and not have to deal with a bank. So it offers a combination of relatively high interest rates, short-term maturities, which allows for a degree of liquidity in the strategy if investors want to get their money back out after a certain period of time. There's a margin of safety because the best operators in this space only lend about 60 to 65% of the value of the property that they're lending on. And also there's some of the funds in this area are using a REIT structure, and with the new tax law that means that the taxes are reduced by 20%, which means that the net after-tax return is very attractive. This is a strategy that is filled with hundreds of providers, and it's a good idea to do a deep dive on the manager that you're going to work with, especially because in a fund vehicle, you need to know that they're handling all the funds as a good fiduciary. So a few things to look at would be, first of all, the track record of the fund manager. How many loans have they made? What kinds of loans have they made? Where have they been making these loans? And do they have enough supply of new loans to be able to put more money to work in the strategy? Second, look at their audited financial statements. Make sure that the auditor is a recognized company that you can trust. Third, check references on the key principles. I think LinkedIn is a great way to see if you know someone in common with the key managers who are going to be handling the money and making the investment decisions. And fourth, there are a number of ways that fund managers in this area can enhance the returns in their funds. I call these the different levers on the business. And this is probably the most challenging part of the due diligence, but understanding exactly how the investment manager generates their returns is very important. For example, using bank financing as part of a fund strategy, so it's a levered fund return, is one way. Some managers make higher leverage loans than others, so they require a smaller down payment on the part of the borrower. Some funds sell some of the loans that they originate to generate extra income. And all of these things can enhance returns, but they also create some additional risk. So it's good to understand what risks is that manager taking on to generate that return. It is a long-term opportunity. The way the banks have been regulated since the financial crisis is very unlikely to change in the near term, and as a result, banks are very slow and cumbersome in their decision making. So this will become a multi-billion dollar industry. There will be dozens of players that generate more than $1 billion a year, and for the next 10 to 20 years I anticipate that the leading companies in this industry will be growing and banks will be shrinking their footprint in this area of lending to real estate investors and developers. So it is worth investing the time to understand this industry because it will become increasingly viable as a place to put capital. The real estate market is cyclical. Both the single family market and the commercial real estate market historically have gone through cycles. Values do not always go down when the market is weaker. Sometimes they can plateau for a while rather than going down. But you do need to be prepared for some kind of a pullback in the market with a strategy. And that is why the best operators in this business limit the proceeds that they will lend on any given loan to about 75% of the cost of the project, which is typically 60 to 65% of the value of the project once the improvements have been made. So the key point of this strategy of investing in short-term real estate loans is to have enough of a margin of safety that even if there's a default and even if the market is dropping, there will be enough equity in the property to be able to foreclose and recover the principal and recover the unpaid interest.